Olá, o meu nome é Miguel Rego, estou aqui da parte da FundsPeople para introduzir o podcast com o tema Ser ativo e flexível na gestão de obrigações. Nesta conversa contamos com dois profissionais experientes e reconhecidos na gestão de obrigações. Por um lado, de Portugal, Vasco Teles, agente de gestão de ativos, gestor de fundos de obrigações e comanda o destino de dois dos fundos que têm tido maior sucesso em termos de rentabilidade em Portugal nos últimos anos. Por outro, de França, mais especificamente a entidade gestora Carmignac, temos Guilherme Rigiade, é gestor do Fundo Flexíveis de Obrigações e Deputy CEO da entidade gestora francesa. A conversa será em inglês e esperamos que se revele interessante para todos os assistentes. I'll now pass the word to the managers. Vasco, please go forward.
Thank you, Miguel. Hi, Guilherme.
Hi, Vasco.
How are you? 2020 was the pandemic year and growth went the floor, but now growth is picking up and apparently we're going to have 4% growth in Europe this year, 6% in the US. Can we extend this sort of growth in the future? I mean, beyond 2022?
You're right that this year in 2021 we expect a strong rebound after the fall we had last year, and the figures of growth are impressive this year. You said 6%, it may be even close to 7% in the US this year, maybe a little more than 4% this year in Eurozone. We expect this trend to continue next year with a limited amplitude. We expect a little bit more than 4% of growth in 22 in the US and 4.1% in Eurozone next year. So it is to say that the stimulus that has been provided by central banks, governments, all the fiscal stimulus that we have in the US, also in Europe, will continue for a prolonged period of time, maybe 1-2 years, to stimulate the economy and to stimulate growth, which is what's enabled after the fall we had last year, which was a dramatic year.
Okay, what about inflation? Because we're peaking in inflation numbers. We're having 6% inflation, 4% inflation in the US, for 3% by year end in Europe, probably. Do you think we may be in a new era of inflation in which numbers will surprise to the upside?
What is really interesting is that in last summer in the US, the Fed explained that they may have a new objectives that would be an average inflation targeting. That they said that they will allow the inflation to increase and to accelerate in order to reach their objective. And what is surprising is that this year, only 2 or 3 months of reopening of the economy has allowed the inflation to be stimulated at a level which is well above what was expected 6 months ago. So the point is, will it last for a prolonged period of time? The inflation in the US will be at a high level for maybe 6 to 12 months. Maybe we are at the peak. You said 4% on a year-on-year basis. It will slow down to 2.5% maybe at the beginning of next year, but it will continue. And the important point for when you look at the market is if this is a pure transitory period linked to the bottleneck we have in the economy or the stimulus, it's not a problem for anyone. But if it's a prolonged period, if you have a change in the regime from higher inflation, then it will justify an answer from the central banks, especially in the US. Inflation for the moment is a pure American situation, and we could discuss about the inflation in Europe, but for the moment it's a pure American discussion. And in our point of view, the Fed will let the inflation ride at these levels for a prolonged period of time. But if we have an acceleration of inflation, then we'll have an answer, we'll have a response from the central bank, and it will be translated into higher interest rates. So the problem for an investor is that more inflation will conduce to a level of interest rates that will increase, and then maybe it could damage the fixed income markets.
So at 4.5% this summer, or maybe this month, in the coming months, it may take the Fed to taper too early, or would you expect the Fed to let it go before tapering until year end?
I think for the moment there is no worries about this calendar. Maybe this worry was there at the beginning of the year. From January to March, we had this increase in the US interest rates, pricing less stimulus from the central bank, tapering, and then hikes of the short-term interest rates. Now we are in a situation where we need to understand if this inflation is a pure transitory or not effect. The Fed explaining us that it's a transitory effect. There is no worries about that. And as a consequence, to answer your question, the Fed has explained that they will not go fast for thinking about what would be a tapering. So they want to earn some time. They need some time, and the market now is convinced about that. And what is the most probable for in terms of calendar is that the Fed will introduce the subject during Jackson Hole at the end of August for a discussion about the tapering at the next meeting in September. So maybe at the meeting after, but we'd say during the end of summer to the winter, we'll have this discussion of a concrete tapering in the US with a start of the tapering at the end of the year or the beginning of next year. And what has been prepared by the Fed for the market is that this tapering should continue for maybe 12 months. And then after, and only after, they will start to hike interest rates. So we need to be prepared for the start of the hiking cycle 1 year after the beginning of the tapering, so beginning of 2024.
Is there a risk that
2023, excuse me, 2023.
Yeah. Is there, in your opinion, is there any risk that because of tapering and taking a bit too long to raise rates, the short term, the long end of the curve may get some turbulent times ahead, and eventually it spill over to risk markets?
So I completely agree that the most sensitive asset in the world to this question of tapering is the long end of the US yield curve. So the US government bonds with the longest maturities are the most vulnerable to this eventual tapering by the Fed. So in a portfolio, you need to be prepared for that with no exposure on the long end of the yield curves. And even you can be negative in duration in order to protect your portfolio, because this asset will suffer. The question is there a contagion to the other assets, especially the risky assets like equities or corporate bonds? And there, it depends on the nature of the rise of interest rates. If it's a rise linked to a rise of inflation expectations or real rates, it will not have the same effect. If it's an inflation repricing with higher inflation expectations, we can understand that it will be a consequence of a better economy, so maybe not a damage for the risky assets. But if it's a rise of real rates, it could impact the growth, it could impact the risky assets because it reduces the liquidity. This is what we had in March this year. We experienced a rise in real rates with some turbulence, some volatility on the credit market. I would conclude this point saying that the Fed is absolutely aware of this situation, and they will do whatever they can to prevent a taper tantrum in the way we had in 2013, when the taper has been translated into very volatile markets with a sharp widening of spreads and plunging equity markets. So they will monitor the market expectations in order to limit this volatility. And maybe I'm too confident in that way, but I'm positioned for, I'm prepared for higher interest rates, but I think it will be gradual enough not to impact too much the risky assets.
Yes. Okay, Guillaume. What about the ECB? Because at the same time, we have this this program running, PEP, which is supposed to mature in March 2022. We see that the hawkish wings of the ECB trying to curb it and to end it there. We have the doves trying to extend it in time and in volume. What's your view on that?
What is very clear is that all these people are quite divided, and the council of the board of the ECB is very divided with these hawks and doves, and it will be very difficult to have a consensus with them within the board at the ECB in order to conduce this eventual change in the monetary policy with a smooth way. As a result, this division within the board will lead to some volatility, and we can already see that the market is not very clear in the way the monetary policy will evolve in Europe. And this is a strong weakness from the ECB we are experiencing. It's that now the forward guidance has a very short horizon. We don't have any strong visibility on what to be prepared from the ECB. For the moment, the market has reacted in sympathy with the American market, with the US market, and the market is prepared for this tapering you talked about from the PEPP, but also pricing some hikes of the short-term interest rates in the coming years. So the market has already taken into account that maybe the ECB will not stay extremely dovish for many years, and what is already priced is a start of the hiking cycle in 2 years, in June 23, and a return to positive interest rates for the short-term interest rates in 5 years. So some tightening is already priced in the yield curve. It is to say that we need to be prepared for some volatility, because doves and the hawks will fight within the board and will be at the end. What is the only thing which is clear is that they work for financial stability. So till we have spreads widening, which is gradual in an orderly manner, we can be confident that they will let the interest rates moving their life and reacting to the inflation expectations and what is happening in the US.
Okay, and it makes sense, but the ECB is working on and it's supposed to show us some results of this long process of its strategic review. They've been talking about it, but most people are not aware really what it's all about. First of all, what is the strategic review all about, and what difference can it make in the future for these as the ECB's as a policy, monetary policy in Europe?
So the point is that they need to formalize, they need to express and to decide what is exactly their objective. What is their target justifying their decisions? For the moment, their objective is to stimulate inflation to a level that will accelerate close to 2%, but below 2%. After a decade of low inflation, we can accept that they are effective in managing the financial stability in Europe, but not inflation. They are not able to stimulate inflation. 7 years ago, when they justified to implement a quantitative easing in Europe, it was for stimulating inflation. It has not been efficient. So they decided to work on how they could express more clearly an objective, and it is supposed that they could go in a US manner. It is to say, our objective is to have an inflation at 2% as an average. It will say that we'll let the inflation increase at a higher level compared to before, because before it was at 2%, but just below 2%. Now it could be 2% on average. So this is a way to express the objective. The other way is that because they have not been effective in the past to stimulate inflation, maybe they have to change the way to measure inflation. So this is something which is weird. You are not able to stimulate inflation, so you change the way to measure the inflation. But it may be a way to do that, to include some components linked to the housing market, to other markets, in order to stimulate artificially the inflation. It's a debate. At the end, what I'm as an investor, what I'm very clear is that the ECB is working for managing the spreads. It is to say the financial stability. But for the inflation, at least still we don't have a very high inflation in Europe or even in the world. They will remain quite dovish. This is the end of this strategic review. May allow some hawks to justify not to be dovish, but at the end they are not able to stimulate inflation, so they will remain dovish for a very long period of time.
Okay, so at the end it may cause some uncertainty in terms of policy making and in terms of inflation allowed to be present in our economy.
It may conduce to some volatility because the uncertainty is very clear. They are not able to coordinate in a very clear objective and a very clear and efficient objective. So more volatility and maybe higher rates, higher inflation, because they would accept that. But I'm not sure they are effective in stimulating inflation.
Okay, Guillaume. You're concerning your activity as a fund manager, I believe you base upon your skills and your style in terms of fund management takes flexibility and constraint as a characteristic of your own and of your funds. And as we've said, growth and inflation are very much peaking this summer. On the other side, you have negative rates in Europe, you have tight spreads in credit, you have equities in historical highs. How important is it to be flexible and unconstrained in this environment?
What you describe with very low interest rates and very narrow spreads, it's a challenge for an investor, for a fixed income investor, because if you buy bonds and you remain invested passively, you will suffer from the volatility that we describe. You may suffer from the rise of interest rates. So we need to address this challenge, and the way to address that for us is flexibility. What does that mean? Flexibility it's a concept, but in our point of view, flexibility relies on three pillars. First, it's active management. Flexibility is to adapt to a challenging environment, so we are active managers. We can adjust our exposure to the markets in order to reflect our convictions and to address the volatility. Second is to be global. If you are flexible, you have the ability to go on all the different fixed income markets in order to take advantage of the opportunities you detect somewhere. And the third point, and maybe the most important to answer your question, is that we are non-benchmark. We have a non-benchmark approach. When you are flexible, you are not linked structurally to a benchmark, it is to say to a passive allocation. And this is a way to address this challenge of very low interest rates, is not to be passively exposed. You need to be active and non-benchmarked.
Okay. And when you say you're reactive, you mean you're reactive on a daily basis, or do you have a longer time period for changing your asset allocation and your decisions?
So if I would have to qualify my approach, I would say that I have a top-down approach. I focus on exactly what we did during this discussion. We focus on the macroeconomic picture. We build expectations in terms of growth, inflation, monetary policies, and then we translate into investment decisions. So with this approach, focusing on fundamentals, going to investment decisions, your investment horizon is quite long, and my investment horizon could be 2 to 3 months, I would say. So it's not it's not a very short-term horizon for investments, but it doesn't say that we are not reactive. We can change our position every day if needed. If we have new information, a new scenario to build about a given monetary policy, but it's a medium-term investment. So flexibility is a strong leeway for the portfolio manager to adapt to the market context, but we don't change our view every day or every hour, of course.
Yes, you just adapt and react. Yeah, I believe so.
Yeah.
Yes, in the same way of thinking, as we've noticed here, most financial assets seem to be quite expensive nowadays. Interest rates, equities, credit. How important is it to have a good risk management in your approach to markets?
It's important because you need to maintain a volatility which is acceptable for your investor. In my portfolio, volatility which is acceptable for my investors is below 5%. This is the way I manage my portfolio. So I maintain my volatility below 5% because I think that for a fixed income investor, it is the level which remains acceptable. And the way to manage and to limit this volatility is to actively manage the portfolio, to include in the portfolio a portion of cash in order to reduce or to increase the exposure of the portfolio. And my portfolio has an exposure to markets which is evolving between 40% to 100%. So I can reduce the exposure of my portfolio if I think that the market will remain too much volatile. So I would say that risk management is the active approach to limit or to reduce eventually the exposure of the portfolio.
So in a sense, it's also your approach on of being reactive in doing some active management, sort of say, it's also part of your risk management approach.
Yeah, and beside of that, we have some constraints in terms of limiting the credit risk with no more than 50% of the portfolio in the high yield or the emerging markets. We don't take any currency risk. We don't take any equities. The portfolio, we limit the equity risk. So we have these constraints, but at the end, what is the most clear for the investor is to limit the volatility, which is the risk which is taken by the investor investing in the portfolio.
Okay. In terms of fixed income universe, in which I think your background comes from, most of it, as I believe you are very much a macro and interest rates background fund manager. Where do you see opportunities in this tough fixed income world we're living in?
Yes, because we said that everything is expensive, which is true. Spreads are back to the levels we had before the crisis last year. So markets are expensive, that's true. But we still see some value, some opportunities in some assets. And I can say, I will tell about four themes in our portfolio. As we said, this year is a year of economic rebound. We had a strong slowdown, recession last year. Thanks to the stimulations we had from the central banks and governments, we have a strong rebound this year. So all the issuers, so corporate bonds, which are linked to the reopening of the economy and which suffered a lot last year, that may recover this year, still offer some value. So in our portfolio, we are invested in the high yield euro market, especially focusing on the leisure, travel, and airplane issuers that are the most sensitive to this recovery. The second theme, and which is linked, is all the issuers which are linked to the energy sector. With the rise of the oil price, thanks to the reopening of the economies, all the issuers linked to the oil industry may benefit from that and present an opportunity and offer some value and present some opportunities. So these two kind of stories are linked to the reopening of the economy and the rebound in the economy. The third one is about financial assets. In Europe, you have subordinated financial debt, which is offering still some value because this is the fixed income assets offering the most attractive spread in the fixed income universe. So you may have a spread of 4% on your subordinated financial debt in Europe, which is quite attractive, even especially if you think that there is no systemic risk on the financial sector in Europe, and if you think that the ECB will be there to ensure the financial stability. So high yield corporate bonds, especially linked to energy and reopening, financial debt, and the last point is about emerging markets. If we think that you need to search for a yield, you want to implement strategies with offering some carry because the monetary policies will evolve for less stimulus, but on the short run they will remain accommodative. You need to implement carry strategies, and for that, emerging markets are very attractive. They suffered a lot from the crisis. They still offer some value. So in our portfolio, we have all these assets. But as I said, markets are expensive. We want to reduce the risk of the portfolio, not to be volatile. So we have all these investments in yielding assets, but we have 30% of cash in our portfolio in order to absorb the volatility we could experience on the market.
Oh, that's quite a bit. Anyway, as we mentioned, we're about to have or enter eventually in a new era of inflation. And the question that arises is how to be safe in this environment, and we could spot the inflation linker market as some sort of safe haven for investors, because eventually if inflation really gets to a higher level of buoyancy, could we, even assets such as credit in emerging markets could suffer a lot because of that? Could inflation linkers be the right place to be for fixed income investors?
So you're absolutely right that what I described as opportunities through corporate bonds, emerging markets, financial debt, they are all linked to a risk appetite on markets, and they will suffer if we have a rise in interest rates and we have like a taper tantrum or whatever risk aversion movement fed by a rise in interest rates. And the way to protect your portfolio for that is offered by inflation-linked bonds, especially in the US. Why? Linkers, inflation-linked bonds, is offering you the performance of inflation above a fixed interest rate. So if we have a rise of inflation, you will benefit from the linkers, through the linkers. So in the US, because we believe that the Fed will allow the inflation to remain at a high level, and we believe that the risk on fixed income markets would come from a rise of inflation, investing in linkers can be a significant protection. So we have a significant position, a decent exposure to linkers in our portfolio, especially to the inflation expectations component in the US. In Europe, as I said, I don't believe that the inflation will increase too much. So we are not buying linkers in Europe. We may be even selling linkers in Europe, but we are buying linkers in the US.
Okay, Guillaume, it makes sense. I think our audience is probably taking a close advice on your words. It's been very nice to meet you. I hope the people that hear us will be clear in their minds with your views. And thanks a lot.
Thank you very much, Vasco.
Nice
thank you very much. Nice to meet you. Bye.
Bye.